Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I am Joe.
And I'm Sarah. Today is February 5th, 2026. Let's dive in. We are starting the day with a sea of red across the major U.S. indices. It looks like the honeymoon phase for the tech rally is hitting a significant wall. The S&P 500 and the Nasdaq are both poised to extend their recent losses as we head into the opening bell. The primary culprit? A mix of AI fatigue and some unsettling labor data. Weekly jobless claims came in with a surprise jump this morning, which has immediately signaled to investors that the cooling economy might be getting a bit chillier than the Fed intended. The Nasdaq is feeling the most pain, particularly as heavyweights like Alphabet and AMD take a beating. When the big tech engines stall, the whole index tends to sputter. We're also seeing the Dow Jones Industrial Average dropping in pre-market trading, largely reacting to that employment data. Even the small caps in the Russell 2000 aren't finding much shelter today. They are down as risk-off sentiment becomes the dominant theme. Investors are moving out of equities and into the perceived safety of treasuries, causing yields to slide. It's a classic flight to quality morning, Sarah, but even quality tech is being questioned right now.
Moving north to Canada, the TSX is expected to open under considerable pressure as well. We often talk about how the Canadian market is a resource play, and today, that's not a good thing. The massive 17% plunge in silver prices is going to ripple through the TSX materials sector like a tidal wave. We've seen silver struggle to find a floor after a historic rout, and for a market like Toronto, which is heavy on mining and exploration, that's a heavy anchor. In terms of movers, watch the big energy names. We're seeing Shell report its weakest quarterly profit in nearly 5 years this morning. And while Shell is a global giant, its results often set the tone for the integrated oil and gas players on the TSX. Between falling commodity prices and the general tech sell-off in the U.S., the TSX 60 futures are looking soft. We're also keeping an eye on the Canadian banks. With the U.S. jobless claims rising, there's a renewed focus on whether the Bank of Canada will have to be more aggressive than their American counterparts to avoid a deeper slowdown. It's shaping up to be a defensive day for Canadian investors.
Shifting our gaze across the Atlantic and Pacific, the international picture is equally turbulent. In Europe, the big news is the European Central Bank. The ECB held interest rates steady at 2%, but the mood in Frankfurt is far from celebratory. Officials are openly worried about a rally in the euro and the looming threat of new trade tariffs. The FTSE 100 in London, the DAX in Germany, and the CAC 40 in France are all trading lower. We did see a small bright spot with the London Stock Exchange Group shares rebounding slightly after JP Morgan and Goldman Sachs suggested the market overreacted to AI threats to their business, but that's the exception, not the rule. Over in Asia, the story is even grimmer. Chinese tech stocks listed in Hong Kong have officially entered bear market territory. That is a massive reversal from the optimism we saw late last year. In Japan, the Nikkei followed the US tech lead lower, and in India, the Nifty 50 is facing headwinds as global liquidity tightens. And we have to talk about the other markets. Bitcoin has crashed below the critical $70,000 support level, liquidating over $1 billion in positions. Silver, as Joe mentioned, is in a free fall, and even gold is seeing some volatility as traders scramble for cash to cover margins.
Let's look at some of the major North American corporate stories driving the conversation. The biggest headline is Alphabet. Despite an earnings beat, shares are sliding pre-market because the company announced a massive increase in AI capital spending for 2026. Investors are starting to ask, when do we see the return on these billions of dollars? It's a show-me-the-money moment for Google's parent. Then we have the chipmakers. AMD shares have sunk 17% following their earnings report. Even though they've been an AI darling, the guidance just didn't justify the valuation for many traders. We're also seeing a sympathy sell-off in ARM holdings. ARM shares plunged in after-hours trading despite record revenues. Why? Concerns over the smartphone chip market and a potential shortage of memory chips. It seems the market is no longer willing to reward good news if there's even a hint of bad news in the fine print. Lastly, keep an eye on Qualcomm. They're also getting swept up in this hardware anxiety. It's a tough morning to be in the semiconductor business.
Internationally, the corporate news is just as dramatic. In Sweden, Volvo Cars is having a catastrophic morning. Shares are down nearly 30%. They posted a huge drop in fourth-quarter profits, citing a triple threat of tariffs, currency volatility, and weakening demand. It's potentially their worst day on record. In the energy sector, as Joe noted, Shell is grappling with a 5-year low in quarterly profits. They are keeping their buybacks steady to soothe investors, but the underlying numbers show just how much lower oil prices are hurting the European majors. In the luxury space, Pandora, the world's largest jeweler, actually saw its stock jump. Their CEO announced a pivot away from silver, which, given silver's current collapse, looks like a very timely piece of crisis management. Finally, in China, the EV slowdown is no longer a theory, it's a reality. BYD reported a near 2-year low in sales for January, with at least 6 other Chinese EV brands reporting sharp month-over-month declines. The green growth engine is definitely stalling.
On the geopolitical and policy front, things are heating up between Washington and Beijing. President Trump and President Xi Jinping had a phone call where she reasserted China's stance on Taiwan as a red line, while Trump pushed hard on trade imbalances. The U.S. is now actively calling for a new trade bloc of allies to counter China's dominance in critical minerals. This is a strategic move to secure the supply chain for batteries and high-tech defense, but it adds another layer of complexity to global trade. Meanwhile, the Trump trade is facing some friction. Diplomatic talks between Washington and Tehran are set for Friday, and we're seeing some analysts suggest that political risk is actually starting to drag down the U.S. dollar. With the ECB holding rates and the Fed watching these new jobless claims, the higher-for-longer narrative is being challenged by the slowdown is here reality.
To wrap things up for our investors, the key takeaway today is risk mitigation. We are seeing a synchronized sell-off across tech, crypto, and commodities. The market is reassessing the massive AI premiums baked into stocks like Alphabet and AMD. When you see Bitcoin drop below $70,000 and silver drop 17% in a single session, it tells you that liquidity is being pulled out of the system rapidly. Keep a close eye on those U.S. labor numbers. If jobless claims continue to trend upward, the narrative will shift very quickly from inflation control to recession watch.
That wraps up today's update. I hope you gained useful insights into this volatile pre-market session.
Add your thoughts in the comments and follow for more such updates. This is Sarah
And Joe, signing off.